Once again this month, Congress enacted new legislation that makes important tax changes affecting individuals and businesses. You'll recall that we began last month's update with details on the Trade Preferences Extension Act, which extended a number of trade agreements while making changes to the claiming of the health coverage tax credit and the child tax credit. In a similar fashion, Congress temporarily extended federal highway and transportation spending by enacting the Surface Transportation Act. This stopgap law changes the filing deadlines of certain tax returns and modifies the reporting requirements for mortgages and for estates. Once again, lawmakers from both parties want to offset the cost of the new legislation without raising taxes. In the latest situation, the so-called highway trust expenditures will be funded by tax compliance measures that are projected to generate $5 billion in revenues over the next decade. Under the new legislation, there are changes in the filing deadlines for partnerships and for C corporations. The due date for partnerships to file Form 1065 will move up by 1 month, from April 15th to March 15th, or to 2.5 months after the close of its tax year. This is essentially the same filing deadline that is in place for S corporations. The idea? By receiving their Schedule K-1 on March 15th, more partners will be able to timely report their income by April 15th, meaning that many of them will no longer opt to extend their individual returns. In a similar vein, the new law also postpones the filing deadline for regular C corporations by 1 month. The due date for corporations to file Form 1120 will be delayed from March 15th to April 15th, or the 15th day of the 4th month after the end of its tax year.
Joining us to explain the new law, as well as a series of recent tax controversies, is our regular expert commentator, Barbara Welpin. Barbara is the author of J.K. Lasser's Small Business Taxes, as well as other tax resources. Thanks for joining us again, Barbara.
Glad to be here, Mike.
For the second month in a row, we begin our program with changes to the tax code by Congress. And most of our viewers are finally finished with their 2014 return filings. So tell me, Barbara, are these statutory changes going to affect our filings next year?
I'm sure by now you've all heard about some of the changes in the short-term highway trust fund measure that was passed at the end of July. What this measure does is it changes a number of the filing deadlines for tax years beginning after December 31st, 2015. So we're talking really about 2016 returns that are going to be filed in the 2017 season.
Becky just explained to the viewers about the new filing deadlines for partnerships and for C corporations. What else should we know about the new law?
Well, the big news has to do with the FBAR reporting. The FinCEN Report 114, which until now has been due June 30th, the deadline's going to be moved to April 15th. But the good news is that there will be an extension of up to 6 months. Currently, no extension is possible.
Well, so far you've told us about lots of changes to the filing deadlines. Are there any others?
No, there are some changes in extension. So forms in the 5500 series have a 3.5-month extension. Trusts are going to have a 5.5-month extension to September 30th. And there are some other changes. So it's worth going through the Surface Transportation and Veterans Health Choice Improvement Act.
I thought I also heard about a change in the deadline for W-2 forms. How come you didn't mention that, Barbara?
Well, here we have a change. This isn't by legislation. This is by way of temporary regulations. What the temporary regulations do is end the extensions for forms in the W-2 series other than the W-2G. I believe that this action is because the IRS wants to try to thwart identity theft. We've been talking about that today, and they believe that this action will help to do that.
Essentially what you're saying is no more extensions for W-2 forms, right?
Well, that's not exactly true, because the IRS said that it will grant extensions, but only really in extraordinary situations, catastrophe, fire and storm and such. So it's not going to be automatic, it's not going to be routine, but it will be possible.
Since we're talking about the IRS, and since you mentioned identity theft, let me ask you about another news item before we turn to the highway trust legislation. You've mentioned bad news about identity theft on recent programs, Barbara, including the breach of $600,000 through the service's own Get Transcript application. On last month's program, you told me how the National Taxpayer Advocate highlighted the fact that many taxpayers whose information and/or identity was stolen have had to wait months to get their tax refunds. Do you finally have some good news for us in this area?
Well, the IRS ruled that identity theft protection services that are provided following a data breach are not taxable. So this is good news for customers who've had their identity, customers of businesses that have been breached, as well as employees of these businesses.
How good is this news? Are you saying that all identity theft protection is now essentially tax-free?
Well, not necessarily. This decision by the IRS relates only to the services furnished following a data breach. So if, for example, a company offers identity theft protection as a fringe benefit to employees, or maybe an inducement to hiring new employees, that's not going to enjoy the same tax-free treatment.
Well, it's still good news. So what kind of services are we talking about?
Well, we're talking about services intended to prevent and mitigate identity theft. So we're talking about identity theft insurance policies. We're talking about credit and identity monitoring services, and any other services that would be considered identity theft protection services.
Okay, if you don't mind, let's just return to the changes brought about by the Highway Trust Fund legislation. A few minutes ago, Becky mentioned that they were funded by tax compliance measures. What else is there besides the shift in filing due dates?
Well, yeah, there's a change in the 1098 reporting by mortgage lenders, again designed to combat fraud. So they're going to have to report more information on the 1098, but this isn't immediate.
Yes, lenders do send out 1098 forms to anyone who has a mortgage. Who else has a reporting obligation under the tax code?
There's, very important, a new reporting burden on executors to tell heirs the basis of the property that they inherit.
Well, as I understand it, the IRS is concerned that they are being whipsawed. The estate wants to report a low date value to minimize their taxes, while the beneficiary wants to report a higher date of death value as his or her basis for the asset. The service doesn't care whether it's high or low, they just want it to be consistent. So the idea is that executors must file these information returns, right?
Yes, and technically it's already in effect because it was in effect as of the effective date of the law, July 31st, 2015, for estates having returns due after that date. But fortunately, the IRS has already postponed the due date, so these statements will not be required to be furnished before February 29th, 2016. Now, when they are due, executors are going to have to furnish them within 30 days of the due date of the Form 706.
Okay, does this also have an impact on the step-up in basis rule?
Well, not at all. The stepped-up basis rule continues to apply. What it means is that heirs who inherit property are going to really have to use the estate tax value as their basis when they go and they sell the property. What it also means is that the heirs are going to have to retain this information until they sell the property, and then for at least the period in which the IRS has to audit their return, so at least 3 years after the sale or longer.
You mentioned the statute of limitations during which the IRS can audit estate tax returns. Didn't that recent law, the Highway Trust Bill, also make a change in the statute of limitations?
Well, I think we all remember the Supreme Court decision in 2012 in the Home Concrete case, which said, that case said that an overstatement of basis which results in an understatement of gain on a sale, does not constitute an omission of gross income that would allow the IRS 6 years to audit. What the new legislation does is reverse the decision. So what we have now is the situation where if you overstate basis in order to underreport the amount of gain on a sale, that will constitute omission of gross income, triggering this 6-year statute of limitation for audits.
Okay, let's make sure I understand the implications of the law. Now, the service has up to 6 years in which to audit a return if there is an understatement of gain resulting from an overstatement of basis. And this is effective for returns filed after July 31st, 2015, as well as returns for which the statute of limitations is still open.
Well, that's not all. A couple other points. Veterans who are receiving care from the VA, they're not going to be counted for purposes of the employer mandate. Also, veterans with a service-related disability who are receiving care will be able to have health savings accounts.
Thank you, Barbara. We'll return to your commentary in a minute.
Over the past year or two, we've spent some time examining the tax situation surrounding the so-called limitation on home mortgage interest. Most viewers are well aware that under Code Section 163, personal residence interest is deductible on a mortgage up to $1 million that was used for acquiring or improving the residence. In addition, you can deduct the interest on another $100,000 that is secured by the residence and can be spent any old way you want. By the way, those numbers were set in 1987 and are not indexed for inflation. That $1.1 million limit is the same whether you are a single person or a married couple filing a joint return. And if a married couple files separately, they each have a $550,000 limit. But what about two people who are not married who jointly own a residence, say a $3 million home with a mortgage of $2.5 million? Do they each get to deduct the interest on $1.1 million, or is the limit per house rather than per taxpayer? Bruce Voss and Charles Sovey, domestic partners under California law, co-own 2 California residences, one in Rancho Mirage, the second in Beverly Hills. The taxpayers filed separate federal income tax returns for 2006 and 2007, claiming separate amounts of mortgage interest indebtedness up to the $1.1 million limit. From our previous coverage of this controversy, you may recall that the IRS disallowed a portion of the deductions for mortgage interest on each taxpayer's return, determining that the taxpayers were jointly subject to the Section 163 limit. A few years ago, the tax court upheld the IRS's deficiency, explaining that the limitation should be applied on a per-residence basis, not a per-taxpayer basis. But recently on appeal, the Ninth Circuit Court of Appeals reversed the tax court's verdict, rejecting the tax court's analysis.
I know people deduct the interest on their mortgage, and I know there are limits under the tax code. You can deduct the interest up to $1.1 million, whether you're married or single. But Barbara, what happens when the 2 co-owners of the house are not married? Is the limit per residence or per taxpayer?
Well, that's the crux of the recent case. The question is, should the dollar limit apply per residence or per taxpayer? The tax court said it applies per residence, but now the Ninth Circuit has reversed the tax court and said it applies per taxpayer.
I suppose I should have asked you a question before you gave me the tax and legal reasoning. To my mind, the $1 million acquisition debt seems high for most homeowners. Please explain to me, why do these dollar limits even matter?
Well, in the case, we're talking about California and expensive parts of California at that. In the case, there were 2 co-owners of 2 homes. One was in Beverly Hills and one was in Rancho Mirage, which is near Palm Springs. And the total indebtedness on the 2 homes was $2.7 million.
So the appellate court reviewed the language of the tax code, which isn't clear on the issue, and they decided that the dollar limits apply on a per taxpayer basis.
That's right.
Okay, so what happens when these dollar limits are nevertheless exceeded? In this case, each homeowner had a total interest of about $1.35 million, which is certainly more than the $1.1 million total limit.
Well, fortunately, here we do have good guidance. You have to make an allocation for the interest, and this is done by multiplying the interest by a fraction, and the numerator of the fraction is the dollar limit, the $1.1 million, and the denominator of the fraction is total debt. So you just use the fraction to find out the allocation that determines the deductible interest.
Okay, so this case is good news for the co-owners of expensive homes in Silicon Valley and elsewhere within the Ninth Circuit. But what about your neighbors in Florida and my neighbors in New Jersey who have very expensive homes with very high mortgage amounts? Are they now free to ignore the limit?
Well, that's unclear. Clearly, for taxpayers elsewhere, we still have the tax court decision that runs counter to this favorable one. We have to wait and see whether the IRS will acquiesce to the Ninth Circuit decision. Let's wait and see. You may have to litigate, actually, if you're in other circuits, but let's wait and see.
Before we move on to another topic, Barbara, you told us a few months ago about the tax implications of the Supreme Court's decision in the Obergefell case about same-sex marriages. Now, on the one hand, they are now able, anywhere in the U.S., to get married and to file joint returns. But on the other hand, it might make sense from an economic or tax perspective to stay unmarried and file individual returns, wouldn't it?
Well, look, you may not want the tax tail to wag the dog, but certainly you have to pause and think for co-owners, unmarried, with expensive homes. You do have to pause.
Oftentimes in a divorce, the higher earning spouse must make various types of support payments to the lower earning spouse after a divorce petition has been filed. A rigorous regulatory regime governs the characterization of support payments as alimony for federal tax purposes, and it is a set of rules that has frequently been changed. Under current law, payments qualify as alimony or separate maintenance only if 1, they are made in cash, 2, they are made as a result of divorce or separation with a written decree of support. 3, they are required under a decree incident to a divorce or separation. 4, the spouses or court do not elect that the payments not be designated as alimony. 5, the couple do not live together or file a joint return. And 6, most importantly, the payments cease upon the death of the recipient. Which brings us to the case of Michael Muniz, an inactive CPA who was divorced from his wife in Florida in 2011 by mutual agreement.
Well, there's no shortage of divorce tax cases for us to discuss, Barbara, and I assume you have a reason for selecting the controversies surrounding Michael Muniz.
We had a case that arose in Florida, my state, where state law allows for a lump sum payment of alimony. And the question is, can that be deductible for federal income tax purposes?
Well, the Florida courts grant the divorce, and they call the payment alimony. What do you mean when you say it might not be so for federal tax purposes?
Well, as you know, Mike, there are 5 requirements in order for payments to be treated as deductible alimony by the payor spouse, and they obviously would be taxable to the payee spouse, the recipient, getting the payment. One of these requirements is that the obligation to make the payments must end on the death of the recipient.
Okay, so what happened here?
Well, again, here we're talking about state law. The decree required the husband to pay $45,000 in a lump sum to the former spouse. And the question is, does or does not that obligation end with the death of the former spouse?
Okay, it wasn't specified whether there was a continuing liability, but even though it wasn't specified, there is at least under state law. And you're telling me that even though the payment was called and was viewed as alimony by the courts, it wasn't alimony for federal tax law purposes?
Well, that's exactly right. So the agreement didn't specify whether the obligation to continue to make the payment would continue past death. State law said that it would, and therefore it did not meet one of the federal requirements for deductible alimony.
If it's your client, you'd advise him of the conflict between the federal and state definitions of alimony. But what can you do if the client has already completed and signed a divorce agreement? It's too late, isn't it?
Well, I think it is our responsibility to advise family law attorneys about the federal rules for alimony so that the agreements can be drafted to achieve the results that the parties want.
There's another tax situation besides divorce disputes that involves a conflict between federal and state laws. It involves so-called marijuana dispensaries. Now, currently, about 1/2 of the states permit the sale of marijuana for medical or recreational use. And despite this liberalization of the laws, marijuana is still considered contraband for all federal law purposes, including the federal tax code, right?
Well, there are several issues, and let's run through them. The first one concerns whether these businesses can deduct their expenses. And unfortunately, there's Code Section 280E, which prohibits deductions for business expenses for businesses that traffic in controlled substances that are banned by federal law.
In this particular case, the owner ran a business known as the Vapor Room. It was a dispensary for medical marijuana in San Francisco, where it is legal under state law. The Vapor Room provided patrons with a place to buy and consume medical marijuana and to socialize. As a result, the tax court agreed with the IRS. This was a business that was trafficking in illegal drugs. Even though it was permitted under state law, the Ninth Circuit agreed with the IRS and the tax court.
Well, that's right, and this isn't the first time this issue has come up. It's come up in other cases, and they've reached the same conclusions. When we think of trafficking, we think of illegal drugs, we think of illegal sales, but in point of fact, the courts have concluded that because these sales are illegal under federal law, then for purposes of federal income taxes, they're illegal. They're still contraband.
What about the owner's argument that the Vapor Room was more than just a marijuana dispensary?
Yeah, the owner did provide a variety of legal services, pizza, tea, and yoga, but all of these services were complimentary. In other words, he didn't charge for them. They were just part of the ambiance of the place.
So essentially, the only income-generating activity was to sell marijuana. As a result, all those other services and amenities don't change the nature of the business here.
Well, that's exactly right. So, result, all the income from the business has to be reported, but no business deductions allowed.
In a similar vein, and somewhat related, is a ruling by the IRS. It concerns excise taxes imposed by the state of Washington on the sale of marijuana. Was the IRS as strict in this ruling as they were with the Vapor Room?
Well, yeah, here the IRS was kind of nice to the owner, kind of generous in the conclusion of allowing the owner to offset the sales of the marijuana sales by the excise tax paid to Washington. Remember, taxes, business expense would be non-deductible under Code Section 280E, so at least they're getting the break or the benefit, if you will, from having paid the excise taxes.
There are other agencies in the federal government that also regulate the sale of marijuana. So what happens if a marijuana business's inventory is seized by the federal government? Can the business write off this loss for tax purposes in some way?
Well, no, and this was illustrated by a tax court case involving a dispensary in California where the DEA seized $600,000 worth of marijuana. And he was stuck with the economic loss, but he couldn't get a tax loss.
So it's a double whack. He couldn't treat this as part of his cost of goods sold, and he couldn't take a loss deduction under Code Section 165.
Well, that's exactly right. He couldn't take a COGS treatment because he just had terrible records. He actually destroyed records. So he couldn't construct his inventory, so he couldn't be treated as part of the cost of goods sold. And as we've been talking about, he couldn't take a loss deduction because under Section 165 because of Code Section 280E.
It's difficult to run a business that's illegal for federal purposes. For instance, they can't even open a bank account. From a tax perspective, I'm curious, how do you pay your employment taxes if you don't have a bank account?
Well, one of the biggest problems that these businesses face is paying their employment taxes. As you know, employment taxes have to be deposited electronically. In order to make an electronic deposit, you have to have a bank account. But under federal law, these businesses can't have bank accounts. Some businesses want to actually have volunteered to pay their employment taxes in cash, but the IRS says this can't be done either.
Well, not surprisingly, there was a marijuana dispensary in Denver, and they were penalized by the IRS for not paying their employment taxes electronically. Now tell me, what happened when the dispensary challenged the 10% penalty in tax court?
Well, this case was settled. Whether a similar settlement will apply or a similar position will be taken by the IRS with respect to other marijuana dispensaries, who knows? We don't know. In July, there was a bipartisan bill introduced in Congress that would allow banking for these dispensaries.
I have to admit, the proposed Common Sense Marijuana Business Access to Banking Act sounds like common sense to me. The law would permit the dispensaries in those locations where marijuana is legal to open bank accounts. This would allow them to pay their taxes, to accept credit cards for payments, to seek loans for expansion, to use other banking services. And since you brought your crystal ball with you, Barbara, tell me, is there any chance of passage here?
Well, I don't know. There's still resistance in Congress to further this legislation. In the meantime, some credit unions are providing some banking services for these businesses. So considering that about half the states now are dealing with this, I think we'll see some movement down the road, but when, I don't know.
Viewers may recall that the Treasury Inspector General advised the Internal Revenue Service to increase its examination of individual tax returns, reporting losses from rental real estate. According to recent statistics, it does not seem that the IRS needed much prodding in this effort. In recent years, we've highlighted that many individuals, in order to escape passive loss classification, are materially participating in the activity and are qualifying as a real estate professional under the tax code definition. Specifically, Code Section 469 requires that a taxpayer meet two tests in order to be considered a real estate professional. One, you must show that more than 1/2 of the personal services you performed were carried out in real property trades or businesses in which you materially participated. And two, you must show that you worked more than 750 hours in real property trades or businesses in which you materially participated. As recent cases have illustrated, the first test only becomes an issue if the taxpayer is involved in an occupation in addition to real estate. How to meet this test, other than by counting hours, is a difficult question. After all, as you will see in the next case from Mike and Barbara, the IRS certainly counts hours in determining whether a taxpayer meets this test.
No, you won't be surprised, Barbara. Many of our viewers' clients own rental properties, and they've got losses that they'd like to deduct. Before we discuss the latest case, remind me, why are so many taxpayers claiming the status of qualified real estate professional for the first time?
Well, I suspect this has to do with the additional Medicare tax on net investment income, the NII tax, and being able to establish yourself as a real estate professional, you get to deduct your losses. So that helps to minimize or avoid the tax.
Okay, you've got to be a real estate professional in order to deduct your rental losses. And that means, according to the statute, you've got to spend more than 750 hours in the trade or business in order to qualify. Does that mean that someone who has a full-time job out of the real estate industry can never qualify for this treatment?
Well, theoretically, it can be done, but a recent case illustrates that it's really hard to do it. The case involved a teacher in the LA school system who was required to work a minimum of 8 hours a day on and off site. Well, during a leave of absence, he got into real estate. He eventually acquired 5 properties that he was managing, and he claimed to be a real estate professional so that he could take his losses.
The properties he owned threw off substantial losses in 3 years: $35,000, $137,000, and $98,000 in round numbers. The IRS agreed that he materially participated in the rental real estate business, and he had logs to show the hours involved. But where they disagreed was whether he was a real estate professional, because he was also a full-time teacher. So the question is, did he spend more than 1/2 of his hours on the rental real estate business? I know the IRS didn't think so, but Barbara, tell me, what did the tax court say?
Well, the court in this case gave him a thumbs down. Yeah, he did have logs to show the hours of being a teacher and being in real estate. But unfortunately, the logs were suspect here. For example, one entry showed he spent 25 hours one day doing real estate activities.
He admitted that he spent 6 hours teaching each day that school was open, and he had time logs. Now, why did the court reject him as a qualified real estate professional?
Well, the court here said, look, the law does not specify how you have to prove that you're a real estate professional. But having the logs, they have to be meaningful. The court said, we can't, and I'm just paraphrasing here, we can't divorce ourselves from what we know in daily life. He greatly inflated the time taken, the time needed to write checks. We all know how long it takes to write a check. So the court, said, forget it. These logs can't be respected, and we can't use them to treat him as a real estate professional.
So theoretically, it's possible for someone with a full-time job to also be a qualified real estate professional. But practically, this isn't easy to prove, is it?
Well, as with so much in the tax law, it all comes down to record keeping. I know this is a chore that we don't like, our clients don't like, but I think we really have to emphasize the importance of doing it, because you can see the outcome often depends on good records.
Barbara Weltman, thanks for bringing us up to date on so many topics. See you again next month.
Thanks, Mike. See you next time.